you will find very clear principles. Just like in snowboarding, you go through injury, you find principles of what work and do not work in snowboarding. Same with real estate investing.
He was an investor first, looking for a tax deduction because he was getting crushed in taxes as a professional snowboarder. And he just found himself here because of his own personal journey. He didn't just get into real estate because he was looking to make a bunch of money syndicating and going out and seeking investors. He did it because he himself was the investor. Everybody, another week, another wealth webinar. Thank you all for joining us. We're at 108 people and it will climb north of that. Today, we've got something really exciting. We've got a guest, sort of somebody I watched his career literally almost through a microscope. He's a professional athlete, a professional snowboarder, but not just, a professional snowboarder. He was a professional snowboarder like none other. And I just want to kind of give you guys a glimpse of what I'm talking about. I got two little videos to show you about today's guest. But I do want to preface real quick before I pull these videos up. This is what he used to do. He now is in the real estate business, but that's what we're going to talk about primarily is opportunities in real estate and some of the things he's doing, which I am absolutely in love with. I love their model. I love everything they stand for. And that's what we're going to talk about. But before we get into real estate, I just thought we'd have a little bit of fun and show you who your guest is. And not only that, show you why he was one of the top snowboarders in the world. And some of you will say, this guy's crazy. Oh my God, there's so much that could have went wrong on so many of those things. Oh my God, Dan, welcome to the Wealth Webinar Show.
Hey, thanks for having me. Yeah, it's been a while since I've seen that video, and gosh, it brings back some memories. They were those shots. Each one of those shots took sometimes maybe days to get done. It's a quick 8-second clip or 3-second clip, 5-second clip, but the amount of time and effort and money spent to get to that level, it was a grind. It was fun.
Yeah, it was an epic time. I mean, that's back when I had my skateboard, snowboard shops. I was also riding professional, but I was sort of at the tail end of my career while your career was literally just blossoming. And, I look at that video very different than a lot of people. First thing in the credits, Mark Dangler was one of the editors, and Mark Dangler was a personal friend of mine. He edited our final film that we made called Do It Right. So I got a lot of similarities there to some of the folks that are in there. But also the other thing I'm looking at is I'm like, man, Dan, if you just went a little bit too fast on any of those, you would have flat landed and you wouldn't have knees left. That's the thing nobody really can comprehend or understand unless they're doing it. Like the precision on all of the things you saw him doing. He's dropping 20, 30 feet. And there's a lot more other footage of him doing even crazier things. But if he just went just a little too fast and like missed those little landings he was hitting and landed flat, like I don't know if your body could have handled that.
Yeah.
I really don't.
It is the most scary part. The first time, everyone, you always, it's such a funny thing. You'd think that at a level like this, you'd have this thought out process of exactly how to get the speed, but literally it's Rochambeau, it's rock, paper, scissors. And if you lose, you're going first, period. And so that first hit is the most challenging because of that exact point, Chris. As you know, speed is everything.
It's everything, or it's literally the end. My career was ended, by overshooting a jump out in Mammoth, and just that Rochambeau. I was just like, all right, I think I'm going to go straight. And I should have checked probably 2 times, and I took off. And next thing I knew, I watched landing go by, and it felt like eternity until I hit the ground. And when I hit, I just crumbled. And every single one of those that you just saw on there, like that could have been the result there, but you did the better Rochambeau, and you just crushed it. I mean, just in snowboarding, your name will just never die because you just did things nobody else is willing to do. But the thing I also want to segue the snowboarding career to is, as any athletes, I don't care if it's football, snowboarding, soccer, the career ends. The dream one day just ends. And Dan, I don't know the story of how your career kind of fizzled and you ended up in real estate. So I think maybe let's just start there. But the other thing I want to talk about, folks, and this is really important, we're not here to talk about snowboarding, but there's a parallel. His risk calculations in snowboarding are the same risk calculations he probably applies in his business now of real estate. And right now, you've heard us talk a lot about risk. You've heard us talk a lot about the risks in any kind of investing, given the economic conditions that we're in. And one of the things that I love about what Dan and his partner do in their company is they have a keen eye for risk, and also have a keen eye of looking into the future as to what risk mitigation looks like in the years to come in the real estate rental business. And that's one of the things I think we want to talk about. But Dan, let me kick it back over to you. They just saw your snowboarding career, but now you're in real estate. Where did that transition happen and why?
Yeah, so I'm so excited to be here, Chris. This is fun. I had this dream as a little kid in Minnesota to be this snowboarder and put everything into it. Come 15 years old, I make a very clear decision where I'm going to make it as a pro snowboarder or I'm going to die trying. And that's how committed I was. I know it sounds a little bit extreme, but I wanted it so bad. So I moved to Salt Lake City and ended up going through 3-4 years of really a lot of struggle, a lot of setback, injury. Realized I wasn't as good as I thought I was. And I realized the pro riders were much better than I realized. Coming from a small town in central Minnesota with a vertical rise of 300 feet, small hill, Powder Ridge, where I grew up, central Minnesota, it's just not even the same ballpark as when you go to the mountains and you're riding. A lot of the stuff we saw here is all urban, but a lot of it's big park jumps and backcountry terrain. And after a big grind, long grind, 3-4 years, working odd jobs, payway, Blockbuster, finally one of my good friends says, "Hey, you're good. You should go to the Aspen Open." And I'm like, "I'd love to go, but I don't have any money. I don't have a car that can get me to Aspen." That's how broke I was. I was living paycheck to paycheck. My parents loved me. They supported me, but they didn't give me any money. They said, "Go for it." My buddy throws me in his car, drives me to Aspen, pays for my entry fee. There's 275 kids. Anyone in an open can enter. And ended up making finals, meaning you finish top 15. And then finals day, I won the contest. And that was the beginning of, a 15-year run as a paid professional snowboarder. That's when the brands that I was kind of coming up on started to take note. I started to get invited to a lot of other pro events. I started to go on film shoots all over the world, really. I ended up being a part of X Games 6 times. At one of the videos you just watched, there was one of my real snow parts for X Games. The real series came out right at the prime part of my career too, which was just timing was unbelievable. I'm here in my, just coming to like my peak of my career, hitting my urban levels at the highest level I've ever ridden at. And all of a sudden X Games comes out with the real series, real snow, real moto, and real street. So real snow is for snowboarding, real moto is for dirt bike, and real street was for skateboarding. And I got invited to that year one. And I was with all my heroes, like these guys who were at the pinnacle, these dudes who I looked up to. When I was in high school, stuck in school, watching videos and looking at magazines, I was competing against these guys. And I'm grateful to have said that was the first time I won an X Games gold medal. But that was the process. It was a grind from 15 to 23. It was invest everything and laser focus on one goal, major setbacks, major injuries. I saw someone ask, how many bones has he broken? I've broken collarbone, dislocated kneecap, chipped kneecap, multiple concussions, which are the ones I'm most nervous about, broken wrists. I mean, it happened, sprained ankles. So, but anyway, career ended up going really great. I had a 15-year run, but like you said, Chris, midway through my career, these guys who were my heroes, who I got to know really well, I could see the writing was on the wall. Their careers were winding down, and it was scary. It was brutal. You know, a lot of these guys losing their homes, divorce, drug addiction. I mean, suicide, unfortunately. A couple of my buddies, really good friends. I was more disconnected, didn't really realize how hard it was with the transition, because as an athlete, your identity is you're a snowboarder. That's all I was. That's the only thing I had. You know, that's who Dan Drisse was, is you're a snowboarder, period. I didn't have a college backup plan. I didn't have a backup plan. This was the plan. So I think that transition can be really dangerous and scary for athletes. And I'm grateful to have got into real estate investing. You know, midway through my career, I'm trying to find a place to put the money I was making. Finally, I'm making good money. And coming from small town Minnesota, not making more than $5,000 a year, all of a sudden I'm making $500,000 a year. And I'm like, holy smokes, this is a lot of cash. Government's taking a bunch of it due to taxes. I'm self-employed athlete, so I'm paying 40 to 50% away to taxes. And I'm like, this can't be how it is. You know, I just risked my life to get here, and now a lot of the income is being taken. It felt like all of it. So I started reading books, and that's where I started to realize, hey, I got to find a way to put the capital I'm making to work. And how can I get a return on that capital and get it to start paying me, and put the money, seed money, I call it seed money, into an asset to give you streams of income. And I'm looking for multiple streams of passive income with a tax savings. So really that's kind of it in a nutshell of how I got him from, you know, never been in snowboarding to a pro snowboarder. And then the transition was over a 5 to 7 year period on the back end, as I started to see the writing on the wall that it was all going to come to an end.
And it's so wild just listening to your story. And just so everybody knows, it's the first time I've ever heard a story about like that whole piece, you know, and there's just so many similarities. I mean, many of you have heard me talk about in the early days of snowboarding, literally, like I come from a very lower income family where like I would literally take my earnings or my awards from winning a contest. I'd go to a contest and not have enough money in my pocket to get home. So if I didn't win the contest, I didn't get the goods or the snowboard that they were giving away to sell in the parking lot to make it home. That's just how it was. And that's how every weekend was. And looking back, I love every minute of it. And yours was the same. You're just constantly kicking and fighting and scratching to get where you are, but you just never lose sight of that dream. But then when you're living the dream, then all of a sudden, and same thing as you, my generation of the athletes I would looked up to were probably a generation ahead, or maybe just an era ahead, I guess is what you'd say. But I remember seeing them kind of retiring out, or an injury would take them out. And I mean, I could go on for days just naming all the athletes. An Achilles tear, done, making probably back then, probably 250 was like the top athletes back then, you know, and then to zero because their contract allowed for 6 months. And an Achilles tendon didn't heal in 6 months. Matter of fact, most athletes never make it back, at least back then. And they had nowhere to go. I mean, Jim Rippey's a great story. I mean, when you look at him, I mean, he was one of the top paid snowboarders of that era, period. And then it just ended. And the story's always the same, but it's just, you know, I found my path in different ways than you, but it's just you have to plan. And it kind of just really sums it up. You landed in a really good space because you were looking for tax savings, which landed you in the real estate spot, which gave you the depreciation. And now what I think is so unique and what I really want to spend time focusing on is I want to transition now from snowboarding, because I could make this hour and a half go all snowboarding. But folks, you all need to get something out of this. So what you just heard is a story of chasing a dream, making it big, top of his game, period. No ifs, ands, or buts. Like the top rider for years. Nobody could contend, and nobody was just crazy enough, some would say stupid enough, to do the stuff you were doing that people just saw. I mean, that stuff wasn't being done by anybody but him back then. Then to find his path into the world of real estate, but not just find his path into real estate, a very unique niche of real estate that he focuses on. And folks, this is what I talk about a lot. I talk about risk mitigation. And I remember talking to Dan. I knew what he did. We were out in Jackson Hole not long ago at a mastermind, and we're talking, and he's telling me about it. And he was in the syndication game, which many of you know I don't like syndications, but I don't like them because I've studied the risks with a lot of syndication. So when I got on the phone with Dan talking about his business model, what did I ask you, Dan? Wasn't it just all risk questions?
Yeah, pretty much. I mean, I think the thing that resonated with you and I most is cash flow. At the end of the day, the most important thing in multifamily is cash flow. The deals that are struggling right now are because they put in variable rate short-term debt. And if you've got variable rate short-term debt, you're in a world of hurt right now, where if you put in fixed debt for a 7 to 10 year period, you're sitting back and enjoying the storm almost. You're kind of excited this is happening because these deals that are coming to market now are distressed deals. These sellers need to get out. So the opportunity to buy is there. but you don't want to be the one selling. So a huge part of real estate, and I'm assuming a lot of your listeners that are educated in real estate, is understanding cycles. And as that cycle ebbs and flows, risk gets thrown out the window, and you have people in 2021, early 2022, when things are going ballistic, they're jumping into deals faster than you could even count. Like, more deals were getting done ever, because they're looking at the last 3, 4, 5 years and seeing these huge gains. But that was the time to be the most cautious. I think about Warren Buffett's quote: when there's, people are being fearful, be greedy. When people are being greedy, be fearful. In 2021 multifamily, you should have been as fearful as possible instead of greedy, because that's what was going on in the market. And now you've got fear in the market, and we're over here so excited because you're starting to see these valuations come down dramatically, and you can buy these deals with low leverage fixed debt, and you can get into a state of cash flow and let the cycle take you back up.
Absolutely. And I think a lot of people, you've heard me talk about the 6 laws of wealth derived from the richest man in Babylon. And, the one is all about greed. Be realistic and never get greedy. And greed is what is going to drive a lot of these syndicators and a lot of these real estate investors straight to the poorhouse or to, insolvency, because they got into deals that they thought were the gravy train, because that's the only word I can use for it, was never going to end. The easy money, the cheap money, and the appreciation. And unfortunately, it's almost a trifecta. All 3 of those have really ended. Banks are no longer wanting to lend or refinance on a lot of these. Values of properties, not all states and all places in this country, but a lot of places are coming down. They're off their highs and they'll continue down. And not only that, appreciation. So the appreciation part's gone, which means when they're trying to refinance for liquidity to buy the investors out based on the agreements, they can't. Because they can't get liquidity. They can't get the banks to refinance. And even if they could get the bank won't give them what they would 2 years ago. And that appreciation model is now going the other way. So when it all comes down to risk mitigation, which I know some of you are on here every week, we got 150 some people on right now, but I know you hear me constantly talking about risk mitigation. And that's why Dan's on here. Because although we're looking to mitigate risk, we're also always looking for the right opportunities to make our money go to work. But the right opportunity has to be the right opportunity for each person. Okay. Each person's risk tolerance is different. Some of you literally go to the casino and you put it all on black and you say, it didn't hit black. Some of you are like, I can't lose any money. And you're looking for opportunities that are the lowest risk. And the reason I wanted to have Dan on talking about his business, and his partner, Mike, also I've spoken to, like the 2 of them, they look at risk so differently. Not only risk from an income standpoint, not an appreciation standpoint, but also the type of buildings that they buy and rent out, the way that they manage those properties, the way that they focus solely on cash flow, but also the demographics around where they buy. And I know a lot of people talk about that, but not in the way that you do, Dan. So can we just kind of hit on some risk mitigation factors and how you and Mike take as much risk out of your deals as possible?
Yeah, when I look at our portfolio, so I bought my first multifamily property in 2012, and here we are, late 2023. We've got 20 deals that we've gone under Granite Tower. 7 have gone full cycle. And when I look at our portfolio, and I see our best performing deals, our deals that are doing good, which would be like hitting pro forma, and then our deals that have struggled. By the way, if you're investing with people, you want to have invested with some people who've had some struggles, because struggles are very good lessons. They teach you principles, kind of like Ray Dalio has principles to his company. You will find very clear principles, just like in snowboarding. You go through injury, you find principles of what work and do not work in snowboarding. Same with real estate investing. And those principles, you do not bend, you do not break. You follow those like they are the gospel. And the 5 principles, when I look at the 5 or our portfolio, and I look at the best performing deals, on our best performing deals, the 5 things we've hit really well on those 5 deals, on those deals, is number 1, we have a remarkable GP team. And GP team means it's the team who's leading the deal. It's the team that's putting it together. They have very high net worth, very high liquidity, and a lot of experience in this field. You want to be with people who have been doing this a decade. Until you've gone through a market cycle, they're still newbies. I even consider myself to still be a little bit of a newbie on year 10, 11 right now. I'm really excited to be in year 20, so I can have all that data under my belt. But your GP team, super high net worth, super high liquidity, and a lot of experience is number 1. That's the foundation. Number 2 is you're going to want to have a location. When I talk about location, Chris just touched on it a little bit. We're in Dallas and we're in Nashville. Those are the 2 markets we're in. And when we go into those markets, we're looking for very specific submarkets where there's an extreme demand factor, where our occupancy in our deal we're buying and the submarket is ideally 95% plus occupancy. And if you can get into those submarkets, that tells you that supply and demand is completely out of whack. Just like anything, any industry, supply and demand controls pricing. So if you're trying to buy an apartment, which we buy apartments, and we're moving rents up, the only way you can move rents up is to have extreme demand. If you don't have demand, people are going to shop around and prices are going to go down. So when you have 95% occupancy in a submarket and you're not buying an A-class deal, A-class is totally different. We buy B and C class, and all that means for B and C class is it's built between 1960 and 2010. That's really our sweet spot. And the reason we specialize in that is because we have more control. We can move the needle. We're not as affected by that new property coming on. So location is huge. After that is debt. I just talked about a little bit. You've got to have low leverage fixed debt. Low leverage fixed debt covers your downside. If we just cover our downside, the upside will take care of itself. Over enough time, 3, 5, 7 years with these deals, when you add value like you do, you get to a place of cash flow with low leverage fixed debt, you will come out the other side in a very nice position. After that is CapEx. CapEx is just what you're going to do to the property. So like, what are we going to do to this asset to bring the value up? What are we going to specifically do? Are we going to put in new kitchens and bathrooms? Are we going to put in a new pool? Are we going to upgrade the soccer field? Are we going to put in a new office? Any of those types of amenities upgrades, that's your CapEx. You want to come in with enough CapEx so you're the nicest little asset in that submarket. Because when you go buy a deal, you're competing against, let's just call it 7 to 10 comps, your competitors. And when you buy a deal, you're going to physically go shop these competitors. You're going to get on the ground and you're going to get to know how each of these properties compare to the property you're buying. And once you do that, you can see pretty clearly of what do we need to do in this deal to bring it to the next level. So we're that shiny little diamond in the rough. That's what you're trying to create with your CapEx. So come in with enough CapEx. If you're cash poor on these deals, now you can't operate them how you should. Now you're cutting corners. Now you're not taking care of your ACs. Now you're getting more maintenance costs. Now you're getting more vacancy. It's a slippery slope. So you got to have good CapEx. And then the last one is property management and asset management. And if you hit those 5 things, you're going to do well. If you miss any of those 5 things, you're going to struggle. And property management, asset management is a whole nother topic. We could talk about asset management for a long time because that's really the meat and potatoes of when you buy and own the business. Now, how do you manage it? How do you work with your professional property manager to implement the business plan with synergy? So those are the things that really, over a 10-year and 2,700 units and 20 deals, those are the things that have stood out to me as principles. And there's several more that I keep in my journal here, but those are the main ones that we're always focused on.
I love that. When you look at the marketplace out there and you look at a lot of the other syndicators, I know many of them are chasing, like you mentioned the shiny object, but they're literally trying to buy the prettiest buildings, and they're trying to like literally just have it almost as like almost a picture they put on their wall. Like, look at my building. Like, it's beautiful. It's brand new. It's all glass. So like, those are the ones that in 2008 during the Great Recession got crushed. Literally, the landlords that owned those big, shiny, beautiful Class A apartment complexes, they got destroyed. Literally, like, that was the feast, because all the people that were ready after the Great Recession and had liquidity, they bought those buildings pennies on the dollar. But the ones that really had no impact were the B's and the C's. I remember this exclusively because I remember during that period of time, I was looking to buy B's and C's and upgrade them, kind of like what you did. And that's what we did as a model, not nearly as efficiently as you did. But I remember watching the B's and C's. They literally held value first off, but the rents went up. So because people were moving from, A's to B's and from B's to C's. So during a recessionary period like the Great Recession, which was a doozy, but I think we're going to be going into a doozy, it's important that he's bringing these things up, folks. These principles that he just went over are going to be incredibly important in the coming years. But also what's going to be important is based on those principles, Dan and Mike, they're going to be looking at these coming years as probably the greatest opportunity of your life. Maybe not. I mean, you're young still. We're all young, but like, these will be some of the determining factors in the next few years that shapes so many people's financial futures, yours being one, and all the people that, you know, are going along the ride with you and Mike on this journey, you know, people that are investing in your deals, like they're going to carry and go on with this. But let's, in there, you had mentioned, you know, the lessons you learned from the ones that didn't do well. Can we just talk about the bad? It's great to talk about the winners, but let's just talk about the bad ones. What happened? How did the investors fare? Like, did they lose? What happened?
Yep. Yeah. So the deals that struggled, let's talk about first. It's a 28 unit deal up in St. Cloud, Minnesota. So a market we wouldn't buy in anymore. Location was softening. We thought the college would ramp up, and it was too dependent on the college. And so being in a lower income, lower demographic area with a college dropping, and what happened was in that submarket is all of the competing homes. This was a 4-bedroom apartment complex. The homes around started to convert to attract college students as well, because they could get higher rent than a regular family. And so the amount of supply went ballistic. So all of a sudden you have a ton of supply, not enough residents, and prices drop. So for that deal, we were on a hold on pattern of like 2 years of, you know, the deal basically broke even. We had low leverage fixed debt. We hit our other parameters, and we sold the deal at break even. No one lost any money, but no one made any money. And for us, that was the wake up call more than anything of location. You've got to get your location into a place where you have extreme pent up demand. Without that, you're going to have challenges. And, you know, another piece is just the demographic that we were releasing to wasn't a demographic we would want to lease to anymore. The income was too low, and it made it more challenging. So you have to understand that piece. And as you get to know why some locations are going to perform differently, it's going to help you kind of hone in on where you'll buy and why. Another deal was out in Carlsbad, New Mexico. Again, a market we wouldn't buy in. It was an extremely strong cash flowing deal, but it was dependent on oil. And we bought the deal, and literally, call it 3 months later, COVID hits. And everybody knows COVID, everyone stops traveling. Oil prices crash. And so there for that deal, luckily, low leverage fixed debt. We had a lot of CapEx cash reserves, and we held on for 2-3 years. We actually still have that deal, and that deal now is coming back with just a vengeance. So these markets, like a Carlsbad, New Mexico, extremely volatile. Dallas is very steady. A lot of major employers, right? You get into a market where you have extreme occupancy. It's just like, it's kind of boring. You want to be bored. I want to be bored. Whereas Carlsbad, New Mexico, that market is doing this, right? And we went through this huge lull with COVID, and then now it comes back, and now you're 100% occupied. You're doing like 80 to 90% rent increases, which is not normal. But remember, we went through that pain, so we had to drop rents 50, 60, 70%. And our occupancy went from 100% down to 60, 70%. So just very good lessons of choose your market. If you're going to go into a volatile market like that, you should be an oil guy. You should have somebody on your team that understands oil cycles. Of course, how do you predict COVID? We know, I mean, maybe some people could have, but it was pretty unlikely, I think, to predict what COVID was going to do, something that we never experienced in our life. But with that being said, again, going back to it, have fixed debt, low leverage, have major cash reserves, have a great business plan. We had good property management, and that deal's on the market to be sold, and we'll do decent on that deal. Those were a couple that come to mind. I can't think of any others that were really like, you know, traumatic for us other than that. I mean, if there were others that have struggled, it's been property management. You know, looking back at your property management team and asset management, and how do you communicate and work with your property manager to execute your business plan. So, you know, like I said, asset management could be a whole nother webinar or talk, but there's a lot of detail there that I don't know if we want to get into, you know, right now.
Well, I want to talk about a couple things here, and I'm going to bring Steven into this because I want to kind of bring this full circle for everybody. You know, when you're looking for places to park your money, and right now, like the biggest thing all of you should be doing is taking gains off risky assets if you can, like 401ks, like get out of the high risk stuff, take your gains off the table. And this is a preservation principle right now. You got to go to the safest assets. But, you know, there's also a lot of folks on here right now that have policies, specially designed whole life policies that they use for the IBC. And there's a lot of cash value. I know, like right now, like I've got a lot of cash sitting on the sidelines, just waiting to deploy. And I'm finding places, but I'm looking for the lowest risk with the best, you know, the best return. I'm not getting greedy, but I want a solid return, and I want some upside on the back end. So I know there's some folks on here that have money in cash value. They have self-directed IRAs that they're trying to say, all right, well, what assets do I go in? And we give them lots of options. But the one thing that's unique, and this is an option I have not given any of them, is one where they can get some tax advantages. And that's a big thing. We're at the year end right now. A lot of people are looking for, how do I get, some extra tax advantages? I know, for example, my mother-in-law, that's all I'm going to say. My mother-in-law just sold a house. She sold a condo. She's got a bunch of money, and she's just like, she's complaining and complaining and complaining about the taxes she's got to pay in capital gains. I said, you made money. Pay the taxes. What are you complaining about? Oh, but if I have done this different, if I had done that different, if I had done this, the CPA said I should have called them before. I'm like, you should have, could have, would have, but you didn't. So like a lot of you might be kind of being a little bit sensitive right now for what you're doing in tax wise, but you want low risk. And the other thing too that I love about what you and Mike do is, you're not sitting there doing your syndication with this whole, cap rate, or not cap rate, but just this preferred rate, like you're buying these buildings. You're not saying, okay, we're going to give all the investors 8% pref with all this upside on the back end. You guys are literally doing it, I think, the right way, and just saying, okay, the building based on the pro forma is going to kick off, this type of a return or this much money in rental on a, and then you're just sharing that with the investors into the projects you're doing, correct? Can you talk just a little bit about that?
Yeah. The preferred return that you're talking about. So it's pretty popular in this world. And preferred return, what it means is that you're going to get a certain percentage before, if there's any cash over, you're getting that certain percentage before any GP gets paid. And it's great until a deal maybe has issues and you feel obligated to continue to send the preferred return, because if you don't send it, it backs up and backs up. And so what I've seen happen in our industry is when you have it back up too much, deal sponsors or the general partners who are leading the deal, unfortunately, they realize I'm so far backed up and the deal's in the position it's not going to be able to produce the cash flow we promised these investors, and we're not going to be able to make any money. So their attention goes elsewhere, or they over distribute when they shouldn't be. So you've got a preferred that's stacking up and you want to get the money, caught up to the investors. And let's just say you have 500,000 of available cash to distribute, but you have CapEx that needs to be done. Again, going back to CapEx, having enough CapEx, you're distributing funds out when you maybe shouldn't be. So the way we've set up our model is that we only get paid when investors get paid, but it isn't a preferred stacking return. It just says when the cash is available and the deal has enough cash, we distribute pro rata. It goes out to the investors based off a percentage of ownership. So we're wanting to get paid as bad as the investors, but it's all dependent on how is the deal doing? Can the deal actually support it?
Love that. Stephen, you're familiar with this space. So I'm going to go to gallery here, and I just want to kind of just do a little riff. So we've talked a lot about syndications, and we've talked a lot about a lot of the issues in some of the syndications. So like, what are some of your thoughts about what he's talking about?
No, it's definitely a great strategy for the right situation. I mean, when syndications, it really boils down to the operator and them knowing what they're doing. And so I've seen a lot of very successful syndications, and the operators, the general partners, do them over and over and over again. And the limited partners are happy. They get, like you're saying, the tax deductions, they get the appreciation, they get the returns, whether it's monthly or annually or however it's set up. So it's kind of the best of all worlds. Real estate's an interesting game because you really see people flood into certain segments of real estate as they become hotter. Like several years ago, single family flips were the hottest thing out there. And then, and that's what everybody was doing. And then Airbnbs became very hot and everybody's doing Airbnbs, and the BRRRR strategy, it's more flipping still, but single family. And so it seems like, and then storage units started becoming very hot. And now we hear a lot about land and probably 5, 6, 7 years ago, apartment complexes were huge, and those have kind of fallen off because they become very competitive. And so, anytime you see people flooding, and syndications just kind of really flooded the market, and everybody seemed to go out there and say, you know what, I was doing flips, but I'm going to do a syndications because their eyes light up by the bigger dollars and being able to raise a bunch of money and on one deal instead of raising money in every single deal and, and everything. So everybody always tries to chase that grass is greener on the other side and chase that magic pill. And it's, you guys know that in life and business, it's not like that. And so I feel like that's what happened kind of with syndications. Everybody kind of jumped into them. So anytime that happens, you see a lot of people that think they know what they're doing and really just don't. You see that with gurus, you see that with some of these education companies and coaches out there and stuff like that. But at the same time, there are some incredible education companies, some incredible coaches, some incredible syndications, some incredible operators. You just got to find the right one. But as far as an investment goes, with all of those advantages in the right situation, I love it. I mean, they're great. So it's my thoughts.
You ever feel like you don't have control of your real estate business or your money? That's right. The big banks and the institutions, they're in control, right? I know you felt that before. Private Money Club puts you back in the driver's seat. As members often tell us, it's a total game changer. Join the community of like-minded lenders and borrowers by going to privatemoneyclub.com and sign up. Now, Dan, I know you got some slides. Do you want to show folks a little bit about like the deals? Like
Sure.
we could talk about the good deals. And while you're doing that, everybody that's watching, if any of you have ever done a syndication, let me know your experience. I know a couple of you had syndications with pref returns that got frozen. I know some of you, have been in the deal a lot longer, because I want to, again, I'm talking risk mitigation here. We got Dan on here. He's got us, his deals are syndications, but done different. It's almost like syndications done differently, and I think that's the important thing. So as you're all putting that in the chat, I'll have Dan pull up some things and we can kind of walk through some of these deals and some of the stuff that he's got. Now, I know my drawing's nowhere near as good as your slides.
Yeah, I mean, this is just an example of a deal that we bought. We bought this, I think it was right around June or July of 2023. I figured might as well run through what a deal looks like, and any questions you guys have, we can answer them along the way. But this is Dallas, Texas, 144 unit deal, a B class property. This is just a confidentiality agreement, quick picture of the pool. So when we buy these deals, we partner with people as other general partners. We lead the deal. They maybe come in and help with some asset management on the side. We give them a task or two, their friends, family, people we know really well, or their business partners who we've done multiple deals with. So that's our general partner group on this deal here. Looking at roles and responsibilities, we're always the lead asset manager in the deals. Granite Towers Equity Group, that's my team at our business. Capital expense project implementation, we're overseeing our CapEx. So when there's CapEx to be done, we're the ones who are implementing the projects from start to finish with our property management team. We do the site visits, the comp surveys, we secretly shop the properties, we do all the asset management. And then, again, down here, additional asset management support. So some of these team members will help with, taking care of maybe overseeing some quotes for the playground, or they'll get us some quotes to help us out with the parking lot, something on the side, because our partners want to be involved. We want to have them involved so they know exactly what's going on. They may bring some equity. Their investors want to know that they're involved. So that's how we've done that. This is just about our current GP team on that deal. Here's the top 7 reasons why we invest in apartments. We talked a little bit about it. Number 1 is, like I said, cash flow distributions. It's what brought me into apartment investing day one. I just wanted to have multiple streams of income so that when my career ended as a snowboarder, I had something to take care of me and something that I didn't have to work for every single day. The forced value creation, that comes with our value add plan. So every deal we buy, and I'll show you our value add plan on this deal in a little bit here, but you're basically bringing in capital to match the competitors or beat them, to bring rents up or bring other income up. And that process forces value by driving NOI. Now, you may, during a market cycle like we're in, where rates are going up, you might have cap rates following it. And cap rates obviously bring valuations down. That comes back down to, you got to have low leverage fixed debt to get through the storm. Nice part about right now is that you've already had a lot of interest rate pain. The pain has set into the market. You're seeing 20 to 30% discounts right now. So you're coming into a market right now, this 2023, 2024, where you're likely to have cap rate compression on your side. So that's the exciting part about buying now, because cap rates rising with interest rates rising, because I think most people believe that over the next couple years, you're likely going to have interest rates either stay flat or pull down some, right? Come down some. And I'm in that boat as well. I think you're going to have some sort of movement down. And when that happens, cap rates are going to come down with it. Risk mitigation through scale. Really, for us, it's if you got a 144 unit apartment, you can have 10 vacants and you're still doing fine. It's not like it's 100% occupied by one single family. So it helps us there. high demand in the right markets. I talked about this a little bit. You just have got to be in an area where you've got extreme pent-up demand. Anything 90% or higher is pent-up demand. Anything 95 or higher is extreme pent-up demand. Tax benefits, talked about that a little bit, just the depreciation. If you're trying to get a tax write-off, like I was trying to get my snowboarding career, here I am making this good money as a snowboarder. My wife, my girlfriend now, was then, but now my wife now, 15 years, she was working at TGI Fridays, bussing tables and being a waitress. And my CPA says, hey, Dan, if your wife could be a real estate professional and she can help manage and underwrite and help you find deals and manage these deals, you can qualify as a real estate professional. So my wife transitioned because she didn't want to be working at, she was doing college. She was also doing the busing and serving. And this was such an easy transition for her. And it helped me us qualify together as a real estate professional to see a tax savings, the depreciation, which was massive during my snowboarding career. It ended up helping us make far more than my wife would have made, working at wherever she ended up going, whatever her career ended up bringing her to. And her goal was to be a stay-at-home mom eventually. So she wasn't on this path to really move up. She wanted to have kids, and we have 3 kids now. So recession resistance, really, like Chris just talked about, B and C class deals in the right markets are going to have good resistance due to supply and demand, due to not many places for residents to be able to go to. So you're able to keep your occupancy high and keep rents growing. And then a hedge against inflation. I mean, we all know it. The Fed creates more currency year after year after year. I was talking with Chris on the phone the other day, and Charlie Munger, unfortunately, I just read he passed away, actually, if you can believe that.
It's sad.
Yeah.
99 years old, though. That's a long life.
Unbelievable. A month before turning 100. I just read that yesterday. He said the only thing he's certain of is the devaluation of the dollar. The death of the dollar eventually is going to happen. So when you hear guys like that using the word certain with investing, I'm very tuned into that. And based off of history, if you look at any country that had currency, which the dollar is a currency, the value of it's going to go down. So you've got to find a place to hedge that. And real estate's been great for that. And if you got any questions, jump in anytime, Chris. I'll just kind of keep rambling here and just
as everybody has questions, just put them in the Q&A. There's a couple up there, but let me hit this one from Jeff, because I think it's relevant before we get into this. He said, what is the GP-LP splits for your deals without pref? So GP means general partners, okay? And then LPs are limited partners, just in case anyone was asking.
Yeah, great question. We do an 80-20 split. We've done 80-20 for the last 10 deals, and it's a little bit below market. Usually it's a 70-30 split, which is more advantageous for GPs. So we do an 80-20 though. 80-20 has been how it's been. It's been working for us. Our investors appreciate it, and that's a good number for us.
So 80% to the limited partners, the investors, 20% to the general partners.
Exactly.
So any of you that were paying attention, that's the right split for you.
Yeah, very advantageous for investors. Here's an asset overview of this deal. So these are some of the things, the amenities that we're looking for when we're buying a deal. 24-hour fitness, you got laundry, online resident portal, pool, picnic area, dog park, covered parking. It's 144 units built in 1978. The occupancy was 96% when we bought it. It's right around there still. This was purchased 6 months ago. It's got pitch roofs, 14 buildings, exteriors, brick and hardy siding. We've redone this office. Looks totally different already. Totally upgraded. Looks amazing. I wish you guys, we have before and after pictures right here, but I should have some here. Looking at, these are the exterior photos when we bought it. Gosh, I should have after pictures right here, you guys. All this brick is white and it's gorgeous. The siding is totally different color. It's just, I think it's a dark green, if I'm remembering correctly on this deal. We put solar screens in here. Property looks totally different. We rebranded it to the Morrison. It was called Grand Seasons, as you can see over here. Man, looks totally different. Totally different. Here's some units that just interior units. So when we bought it, that, this is where they were at the time. We've upgraded a bunch of those units already. Amenities. Here's some amenities when we took over. We've upgraded a bunch of these. We made this fitness center a lot larger, put in new machines here, canceled the laundry contract. So we control that now. Top 5 reasons we really were drawn to this property was competing properties were achieving higher rents. When you're coming in and wanting certainty and risk mitigation, if you can find competing properties that are getting the rents you're trying to get, it gives you really good certainty that when you take over, you implement your business plan, you're able to get those rents. Because what the comps are doing is what you're going to do. It's a pretty good story, at least, to be able to say, hey, we can go to this level. They're already getting it. We love this neighborhood. There's a Trader Joe's across the street, good schools in the area. They're ranked A and A- by niche.com. This comes back to location, you guys. When you're thinking about the 5 reasons you're buying, 5 pillars of buying a deal, location is huge. Again, fixed debt. I'm a raver on fixed debt. Secured a 10-year loan. We locked the rate at 5.17%. It just eliminates any fluctuation, and you're in a low leverage position where you're cash flowing pretty much no matter what. And that makes us just sleep well at night. It gives us a really good chance of being able to overperform for investors. Tremendous value add. Grand Seasons is stabilized at 96% occupancy, had partial upgrades that were done, and we have enough CapEx funds liquid the day we close to come in and upgrade the rest of the units. And then a great track record with the property management team, the management team managing the deal. We have several other deals with them, and they're doing a great job. Here's kind of an example of what it looks like. We had a $21 million purchase price. We raised 12.927 million of equity from investors. Loan amount was 12.232. It says estimate here because as you're going to close, Freddie Mac does a final calculation on your T12, T3 right before closing and gives you the number, but it was really close to 12.2 million units. Again, 144. We projected over a 5-year period a 92% return. So if you put 100,000 in over a 5-year period, we're projecting giving you back 192,000. That's your 100,000 initial plus 92 grand of gain. 18% annualized return, 5% average cash on cash, but that's going up a little bit right now. We were at closer to 6% on our most recent deal. And then you've got depreciation, bonus depreciation will be utilized where we do a cost segregation study in all these deals where, we're going to go in and speed up the losses year one and apply that to your K1 as investors to give you some bigger losses. In this deal, we put $1 million in for skin in the game. Investment was minimum of $50,000 for investment. These are our partners that we've used on most of our deals. We've been with Brazel and Associates they've done 18 cost segs for us. I've been with Provision out of Arizona, which is a CPA firm since 2011. Northmark's done a ton of our deals. Crowdfunding Lawyers does a ton of our legal work. This talks a little bit about Dallas and why Dallas, and there's tons of detail here, but really it's job growth, population growth, landlord friendly, business friendly, and then get into a extremely strong submarket demand area. Like I talked about, 95% plus occupancy with, ideally an asset that's not performing compared to the comps, and we can come in and solve that problem. A little bit more, just Texas is a huge market. When we were talking about our problem deals, and I talked about our New Mexico deal and how we bought in Carlsbad, New Mexico, and the market fluctuates really quickly. When you have a $2 trillion economy, it's the second largest in the US. And, Dallas is this growing state with job and massive diversification of major employers. It makes it very, very easy, very flatline, very, very stable. So that's another reason that Dallas has been a big draw to us. In going into the actual submarket, North Dallas, which is where Morrison is located, it just has a lot of tech companies, AT&T, healthcare is huge, retail, finance. It's all right next door to where we're buying, which brings more jobs. Jobs is everything. If jobs are there, people are there. This is just a quick picture of the location overview, not really worth getting into. Immediate surrounding area. This just shows kind of what's going on, near Grand Seasons. I call it Morrison. We rebranded it to Morrison, but it was called Grand Seasons. And you can see exactly where some of these businesses are, like a Trader Joe's across the street. That's a great sign. Trader Joe's is a supermarket that says, yeah, there's the residents we want to be leasing to are living nearby. So that's just a quick overview. Here's another look at it. Just kind of, there's Grand Seasons back here. You can see Trader Joe's is here. The market at Pepper Square, they're redoing this area. That's right. That's another reason that drew us to the submarket. They're redoing and building right now a brand new shopping mall with a bunch of new restaurants, and it's an up and coming area. The thing that also drew us to this area, you guys, is you see the 1 mile median household income being 63,000. We want to be in a market where you have a strong income, 1 mile median income demographic, unless it's a very specific type of resident profile. Generally Hispanics, you won't see a very high income, but they are very hardworking, and a lot of it's done with cash, and they're incredible to have as residents as well. So that's the one caveat we would move on for our 1 mile. But otherwise, we're trying to be 55K plus, which is critical. You don't have anyone making any money in the submarket, you can't lease to people to pay your rent. So you got it. This has come back down to location. You got to get in the right locations. So the 1 mile is 63 grand and allows residents to pay it. Here's some capital improvement, you guys. So this is a huge part. Going back to CapEx, you got, remember my 5 pillars. CapEx is massive. When you come in and you buy these deals, you want to make dang sure that you're that, when you're done, you're that shiny little diamond in the rough. And so you can see here, we got 1.6 million that's going to go into interior full renovations, 1,440,000 of interior units divided between the 144 units, adding washer and dryer for 84 grand, washer and dryer connections at 5 grand, office fitness center renovation of 40 grand, and unit conversion of 36. So that's all your interior budget. Your exterior budget here, parking lot repairs for 50. You can read faster than I can talk. You got backyards, you got exterior paint, 2.2 million though of CapEx budget that is being put into the property to upgrade the property to make it match or beat the competitors. Business plan. So looking at just your property value increase, and you're probably looking at, okay, this is great, you're putting this money in, what is it worth, how do you value it? And so if you take your opportunity to increase income, you're bringing your rent to market by $154,000 annually. That's because of, remember, the comps are at whatever level they're at, you're going to upgrade units and bring rents to the market. So you're going to have an extra 154 of additional annual revenue. You're going to do a Wi-Fi package. We've done Wi-Fi packages on several of our deals. It brings in an extra 38,000 a year. And then some covered parking over a 3-year period gives you 28,000 a year. And then increased utility collections. A lot of these apartments, you do bill backs, like a RUBS program, where a portion of your bill is paid by the resident based on the square unit footage of your unit type. And that'll give you an extra $248,972. You divide it by a 4.5 cap, you're at a $5.5 million valuation on a deal like this in Dallas, this submarket. And then going into market rent comparison, like, okay, great. You're showing me what Grand Seasons is getting or what you're trying to get. The data, it's all the data. Our investors need to see the data. And in order to make a decision, an investment decision, the data will dictate if it's a deal or not a deal. So you got Rock Creek as a comp, you got Preston Creek, you got Preston Del Norte, you got Tiburon. And this was built in 1978. And you can see the year built for all these properties. You want to be within 3 to 5 years. Otherwise, you're not into a comp. I'm not going to go look at a 2000 year built with 1978. It's not a similar competition built property. You got 1-1s right here. As you can see, 662 square feet. This property here is 1-1-553, 1-1-788. And you can just compare what the competitors are getting versus what you're trying to get. And so Rock Creek, maybe you're not quite there, but these other 3 you are, and these upgrades match what we're trying to do. So we're lower there, we're lower there, and we're lower there. Great. Maybe we can even get higher than 1250 based off of these 3 comps, based on their upgrades. And
well,
you just look at
Dan,
yeah.
I love that you're shooting low, not high. So it's I think a lot of these that I've seen, they're always like, all right, we're going to improve it. It's going to be nicer than the others, and we're going to charge more in rent. That's exactly when you get caught up and get hurt when things turn south. You're coming in lower than most of your competitors.
Yeah, that's the goal. Can you underwrite it as conservatively as possible and over project? Here you got 1325 on a 777 square feet. They're getting 1400 here on an 897, 1700 on a 1200, and then 1725. So again, like you're definitely in that ballpark based on upgrades. Looking at a 2-2, looking right across the board, you can see what they're getting. So it's easier to build your business plan when you can see what the submarket is doing. You got to intimately get to know your submarket. Otherwise, you don't know what you're doing. You don't know how to build your business plan. And then again, going back to occupancy, you guys, you see the 95, 96, 95, 96, 98, 95. That's extreme pent-up demand. There's no place for these people to go. They want to be in the submarket, and they go and shop, and the answer is we're full. We're full. We're full. Now you're back to where you were, and you got a renewal on the table. Are you going to pay it, or are you going to go to a different submarket? The schools, the A- in each schools, people aren't going to leave. They're like, I got to stay in. I want my kid to stay in the same school. I would too, so that's what you're trying to get yourself into, a situation just like that. Just real quickly, looking at the financing, 10-year fixed loan, 58% leverage you got.
The funny thing is, I'm reading the comments, we got 2 CPAs on here, And both of them are talking about how the depreciation can offset the gain at the end and how much of a benefit that is. And I love this part right here that we're talking about, because this is the part that matters for risk mitigation. So Dan, like the leverage, that's the part that everybody levers up, and that's where they get buried.
You're exactly right, Chris. If there's one thing, just get base hits, you guys. You don't need to get home runs. You just need to get base hits after base hit after base hit. And if you do that long enough, you will get home runs because the market will cycle. So yeah, the 58% leverage, it just helps us sleep at night. It's you're in a cash flow position. You have a locked interest rate. You're not having the variable debt. You're not having your loan payment double. I mean, some of the deals right now that were bought in 21 with variable rate debt, their mortgage may have been 100 grand. Now it's 200 grand, 225 grand a month. So you're never going to be able to come out of that. You're done. You're toast. Unless you bought a rate cap, which some of these savvier investors did do, or unless you got deep pockets, you're going to sell, and you're going to sell at a loss, which is exactly what you want to be buying, from these folks. We say don't invest to get wealthy quick, invest to get wealthy for sure. That's our motto here. These are non-recourse loans. You get 5 years of interest only, 30-year amortization. Loan amount is 12.2 million. Big part, again, we talked about it a lot, 100% unfinanced rehab. We have the cash. When we close, it gives us a lot of flexibility. If we were like, let's say you come into a market and you've got $8,500 a door, like a deal we're buying right now. You got $8,500 a door. You're not going to go in and immediately spend $8,500 a door. You're going to test the market. You're going to say, let's do a bunch of upgrades at $2,000 a door, $3,000 a door, $4,000 a door, and $5,000 a door. Let's take 10 units and just test. And if you can get the pro forma rent for $3,000 a door, you're going to continue to work that business plan until the market shifts. That's where unfinanced rehab is so powerful. If you have it financed, the bank says, no, you said this, you have to go do this. Now you don't have the flexibility. We love unfinanced rehab. Plus you got all the cash. You know, if you don't need the money, you can send it back to investors. It's great.
I got one question there that came up that I think is relevant that we hit right here. So somebody is saying, if I'm right, I'm seeing debt at 5.1% right there. You got a locked interest rate of 5.17 bank financing. The person is saying going in cap 4.5. So on the refinance, you expect debt costs lower than in 5 years. And I think this is something we haven't talked about, is how you exit these properties, because we haven't really hit on all the ones that you've done in the past and how you've done them. But like, how would you answer that question for Gigi?
Yeah, so we may or may not refinance this asset. We may sell. So for this deal right here, we're on a 5 to 7 year hold pattern. Our goal right now, I don't care what cap rates are right now. It doesn't matter. We're in our value add plan, and we're executing our value add plan. We're focused on NOI growth. As the market changes, as real estate cycles for the last 150 years, real estate cycles, 200 years in the US, you look at any charts, there's the down, there's the up, there's the down, there's the up. What we'll do is we will focus on the fundamentals of NOI growth. And as we get to 27, 2028, 2029, we will look to see where the debt market is. We'll look to see where cap rates are and what sale prices look like. When we talk to industry experts, when we're looking at CoStar data, ALN, I mean, you look at the biggest search engine sites, most folks are talking about cap rate compression in 2026, 2027, and for sure, high prices again in 2028. So, excuse me, our goal would be to hold the deal till 2028, 2029, get into a nice solid cash flow position, ideally get that 6 to 8% going, and just wait and see. Once the market is at a point where it's frothy again, we'll bring it to a few brokers. We'll get BOVs, broker opinion of value, and we'll bring it out to the market for a sale as long as it'll hit or exceed our returns. And, ideally you blow them out of the water. Worst case, you hit them or you hit them is kind of like your middle of the road. Worst case, you're holding for a cash flow. You're like, we can't sell yet. We got to continue to cash flow the deal. That answer the question a little bit?
Yep, that's perfect.
Great. Yeah, looking at this is kind of it's hard to see. There's a lot of numbers here. Our investors love to see. They want to see exactly, how are you underwriting the deal? What are you doing with the rents? You can see a purchase price at 21 million, 144 units, loaned 58%, $12 million loan, 5 years of IO, 5.17%, just like we talked about. Unfinanced rehab of $2 million, total raise of 12 million. Here's what the current rents are. Here's what we're moving rents to, which when you look at where they are currently versus where we're going, it's only a 6% increase. So
nobody's going to leave based on that increase.
Yeah, and when you bring your $2.4 million of CapEx, if you need it, it helps back up getting that 6% increase. Not a big increase. We were seeing increases, Chris, in 2021 of 20 to 40%, which is not normal. That's not healthy. It's not how the market should be. But you're still seeing 10 to 15% increases pretty dang easily without any capex. You know, maybe in 2024 and 2025, it decreases a bit, but 2026, 2027, you're going to see rents come back with a vengeance. Our expenses, just to, you know, you can kind of see, hey, what did they do over the last 12 months? What are we projecting we're going to do moving forward? And you take those numbers and you apply their T12, and we may add a little bit. Like you can see their contract services, they were down at 42. We bumped it up to 72. You move it around a little bit. The biggest numbers to notice on expenses are your insurance and your taxes. Insurance and taxes, property taxes are the two biggest things. They're at 58 grand. We get a quote from our insurance provider before we close, so we know what we're going to have at 102 grand. And then property taxes, being, you know, property valuations have been coming down. We've been getting some good property tax relief, which has not been the case, you know, in 2020, 2021, 2022. Now, though, with prices coming down, you're not seeing them go up like they were. Here's a five-year cash flow projection. One thing I look at here, you guys, that is worth talking about is your economic vacancy sensitivity analysis. And economic vacancy just means like if you had delinquency, bad debt, lost a lease, physical vacancy, all of that, that's your economic occupancy. And what I like about this deal is our economic occupancy or economic vacancy could increase all the way to 36%. So we could have 36% of the building not paying rent during year one of ownership, and we would still be able to service our debt. Those are numbers in a submarket with 96% occupancy that covers your downside. The chances of a market like this, who's been stable for 10 years at 95% plus occupancy, dropping down to 36% is not going to happen. I mean, if it does, we've got other problems, bigger problems to worry about. Our property tax increase, 100% of purchase price by year 3. We work with a property tax consultant who does all of our property taxes in Dallas, Texas. This is all the company does. They mitigate property taxes for multifamily apartment owners. And they know this stuff. Like, this is all they do. This is their one thing. And then our other income, we're going to be increasing our other income by the end of year 3 by implementing the Wi-Fi package. We came into the property and we put a whole Wi-Fi package in that was installed. It's an expensive CapEx project like you guys just saw. And that now allows us to not use Comcast or Spectrum, and we can come in and we can be the ones who own the Wi-Fi and control the Wi-Fi and provide it for our residents. We can get it to them for a better price, and we control it 100%. And here's another nice part about it. If residents decide they don't want to pay rent, we can turn off their Wi-Fi. You know, like, hey, that's okay. If you don't want to pay rent, and we're going to turn off your Wi-Fi if that comes to be the case. We're not trying to do those things, but at the end of the day, you got to pay to stay. So Wi-Fi income has been huge for us. This just shows our projected rent growth. Grand Seasons pro forma 5-year annualized rent growth at 3.88%. Yardi is forecasting in over a 5-year period 4%. And then CoStar Far North Dallas multifamily historical 10-year annualized rent growth has been 6.05%. So it just shows that what CoStar and Yardi have projected and put in the past, we're using a number below the 4% number. And then right here's your 5-year cash flow model. Annual rental increases years 2 through 6. Your total rental increase is right there. And then let's see here. Here's the summary. Again, this is an example, you guys. I just want to be totally open book for you guys, so you can see exactly when we're bringing out a deal. This is what it looks like. And as you're looking at deals, these are things you should be seeing from other co-sponsors, from other deal sponsors. They should be very open with you about their fees. They should be very open with you about their returns. Again, 92% 5-year return, 5% cash on cash. You do take cash, IRA, and solo 401k funds. As an investment returns example, you got 50 grand put in, you get 96,000 back over a 5-year period. On a $500,000 investment, we're putting your 500 grand back plus your profit, making it 963,850. We do an acquisition fee on all of our deals as 2% of purchase price. Asset management fee is 1.5%. You got an investor sponsor split, again, 80-20 as the question was just asked, and then a disposition fee of 1%. That disposition fee only gets paid if we hit or exceed your guys' returns that we have here. And this is a little bit more about your investment summary of projected returns. Again, the 1.93 equity multiple, it shows like, if you put in 250 grand, what you're getting back each year on the investment, and then total. If you add all these rows up, years 1 through 5, you've got your total 92% return. This is one interesting, this is worth looking at, your reversion cap rate sensitivity analysis. So basically, depending on what cap rates do, what could it do to your return? If you're at a 4.5 cap on a B class deal, or you're going to, if you go up to a 4.9 cap, you're at a 74% return. Now, this is when cap rates were a little bit leaner, but coming back in the next 3 to 7 years, you're going to have likely some cap rate compression sometime in there, and you're going to exit when cap rate compression hits again. Now we're using cap rates a touch higher than this, but you can just see cap rate sensitivity, how it affects your returns. And then investor distributions, we're available all the time, monthly updates. You're going to get a monthly update. You should get a monthly update or a quarterly update from your investors. From your general partners, sharing with you what's going on in the deal, what's working, what's not working. You're going to get your annual tax return, a K1. You're going to get a K1 from us. Any CPAs on here, K1's applied to your tax return. Talk to your CPA about how that loss can be used for your specific income. And then we do quarterly distributions. They're distributed via ACH. So that's kind of it in a nutshell of just a high level look at a deal.
So let's kind of go through some of these questions here. We got some really good ones, and we got we got a bunch of investors on here, and then a couple CPAs, which I think makes it even more fun. So Aiknot says, is there a rule of thumb for a percentage of cash reserves that you maintain?
That's a great question. I love that question. Yes, what we do on a deal, so if it's a $21 million deal, we like $750,000 of cash, just reserves, just sitting there. It's just in case. It's just in case. On a deal of 10 to 15 million, I like 350 to 500 grand, depending on the year built, depending on the asset class. If it's 30 million plus, I like $1 million of reserves, just in case. It's just there, just in case.
Okay. Next question was, Anonymous said, what is the LP cash flow and distribution time frame? So I think we hit this one, but we'll just hit it again real quick.
Yeah, LP distribution. So we asked for a 6-month grace period. Right here actually it says it's 6 months of ownership, just to get us some time to come into the deal, make sure that we have analyzed the deal correctly, nothing major came out of the woodwork after ownership. And then assuming the deal is in a position where we're hitting our pro forma numbers, we're on the right path, then we'll start distributions.
Will said, how long does it take to do all of your CapEx and sub-market assessments? And then how long does it take to go from developing your pitch to investors to raising 12 million? Actually, that's a great question. What is the normal time for the raise? Yeah,
so CapEx, all the exterior stuff, we're going to get that CapEx done in 6 to 8, maybe 12 months max. That stuff is pretty easy. We have our go-to contractors that we use on all of our deals. Our value add plays are pretty similar on most of these deals. Interior now, that may take you 12 to 18 months as leases cycle, because you can't come in, it's called loss to lease, where you've got a lease locked in, let's just say for another 6 months, you can't come in and upgrade and change their rent. So as units come due and you're sending out your renewals, you're going to do your upgrades as you can. You may just do partial upgrades for these folks. A lot of these folks, you offer them a full upgrade and they're like, I don't really want to move out. Can you just give me a new washer and dryer or new, appliances? And I'm happy just with that. And then you're like, yeah, great, perfect. Here's your new appliances. Here's your new lease. Boom, on we go. But 12 to 18 months for interior to get it completely done.
And then you hit the raise, right? That was that one?
Oh yeah, that's right. And the raise, correct. So the raise, it depends. On this deal, I believe the 12.2 million took us probably 3 to 4 weeks. We have a pretty large investor database, and several of the partners we work with have a pretty large investor database. And, as long as your deals are performing and you're doing a good job, it shouldn't take you really more than a month, maybe 45 days.
And then James said, living in California and having clients who are landlords who got totally screwed in 2020 and 2022. I'll add New York to that. How does Texas treat landlords? I already know the answer to this one. They shoot bad tenants. I'm just kidding.
No, such a good question though, you guys. That is why we're in Texas. It's landlord friendly. So when it comes time to evict, 15 to 30 days, they're out. I've heard horror stories. Our asset manager is actually from California, and she talks to us a lot about what they went through there. So I can't say, I don't know the laws in California very well, but with Dallas and Nashville, both in 30 days, that person's out of there.
Okay. Gigi said, so you've presented a lot of data, but at the beginning, what data specs did you use to say, okay, let's put an LOI on this property?
Yeah, that's a great question. So when we're underwriting deals, you guys, this year we wrote like underwrote 278 deals. We offered on 8 of them. I mean, there's a lot to it of saying, yeah, this is why. First, are you in a submarket that you like? Is it an asset class that you have familiarity with, and that, are you buying a B or C deal? Is it in a purchase price that you can handle as far as your capital raise? Does it have a lot of room, meat on the bone, we call it, but room to move NOI by specific value add plays? Can we do X, Y, and Z and definitely move the NOI? So that's a huge part of it. That's a huge play. Really, can you get fixed debt on the deal? Some of these deals, if they're not 90% occupied plus, Fannie and Freddie won't lend on them. Now you're into bridge debt. So all of these factors come into play. When you're underwriting a deal, what's the projections of where rents are going to go, the next 3 to 5 years, 7 years out? Where will they be? Can you get into a cash flow position of at least 5-6%? So all of that comes into play. And then, is there a property manager that we know very well or worked with on several deals that would love to take the asset on? Is it in our bandwidth to be able to add another deal to our company? So there's a lot of things. That's a question. That's a great question, but it's going to take time and more explanation and more teaching to actually say yes, go or no go. And that changes, you guys, too. I'll say this, like, our buying criteria has been changing over the last decade. We weren't always buying $20 to $30 million deals. We started with a $2 million deal. That was our first deal, 45 units. So things change. I bought my actual first property I ever bought was 9 units. I bought a duplex and a 9-unit property. Then I bought a 24-unit property. Then I bought a 28-unit property. Then we first syndicated a 45-unit deal, and then an 86-unit deal, and then 101 units. So all of this changes as you grow and as your company grows and as you get comfortable being able to take care of these deals. Because at the end of the day, you're buying a business, and you got to really take care of the business and the team in order to get those returns. So I hope I helped answer that question a little bit.
Yeah, I love it. And before I get to the last two, there was a couple of people in the chat asking, like, if they had, they wanted more info or they wanted to talk to somebody, like, how would they go about doing that? Like, do you have, like, would they call you? Who would they call if they were interested in looking at this in a deeper level?
Our website is granitetowersequitygroup.com, just www.granitetowersequitygroup.com. And it's just, there's a contact us tab right there. You'll right at the top, contact us, and just, hey, Dan, I heard you on Chris's show and would love to hop on a call. And I'm happy to hop on a call, or Mike can hop on a call, and we can get to know you better. I think a big part of it is getting to know your goals. What are you trying to do? Does this investment fit with what you're trying to do? They're not putting everything you got into the deal. That's not ideal. We're looking for people that are like, hey, I got $100,000. I'd like to try to, be putting it here or there. So hopefully that will, oh, there you go, Chris. Good.
Yep. I just found it, figured I'd just show it so you guys can go on and look at the team, the media, the portfolios, contact.
Yep.
Right there.
Contact right there. That's it. Yep. Go ahead and just go to Granite Towers, contact us. Yep, there you go. That's our one deal up in Nashville that you got. That's an A-class deal. Everything else is B and C.
Perfect. And then James said, how hard to evict, and were there COVID procedures put in place in Texas to protect tenants?
Yeah, during COVID, it got a little bit more challenging to evict, but when I'm looking back to it, it wasn't an issue where it affected the asset so much, where it was, like I've heard horror stories. It was a little more challenging. But I'm hopeful we don't come back into a position where we have COVID, again. But
see how crazy the election gets next year.
Yeah, right. That's it. Yeah, seriously. You think it's not done? You think it's coming back?
I don't know. I hope not.
Yeah.
I hope we never see anything like that in our lifetime.
Seriously. Yeah. Look at the last pandemic in 18, 20, 19. It was 100 years ago, and it was about a 5-year span until it was totally done. So hopefully that 5-year span, we're coming into 2024, and it's just a downward trend from here.
Yeah, well, let's hope so. And then Mark Perry. Mark's, I believe, done a bunch of syndication stuff. He said 506B or 506C?
Yep, 506B. So there will have to be some sort of a pre-existing relationship. Great question. That's where get on a call is just super simple. Get on a call. Let's get to know you, get to know your investing goals, and then you can be in our database. And you'll get a newsletter from us every week. Every week we're talking about what we're seeing in the market. We have a podcast as well called Keeping It Real Estate. You can follow us there and get to know us better there, and that's easy.
Love it. And I think that's all the questions. I want to go back to the gallery mode here and, just kind of rifle off a couple things. A lot of the reasons, folks, we bring people like Dan on the show, and you'll notice we very rarely do this. I got to say, overly protective. We're kind of like, I don't want to call it parachute parents, but we kind of are for all of our clan here, our community here. So when we bring somebody on, we've done a lot of work on the back end to look at them and get to know them and talk to other people about them. And this is no different. Usually, folks like Dan don't know what we do on the back end, but, Brandon and the other people on the team will always go do background checks and everything else. Now, we're not saying that we've done all the due diligence, but enough where what I liked about this, and the reason I wanted to have Dan come on, is it's just unique. It's different. And it's something that we haven't brought onto the show before. You'll notice we never talk syndications. I know a lot of you are always asking questions about them, and I'm always like, no, because I just haven't found one that hit the criteria that we're looking for from a risk mitigation standpoint. Most all syndications I see, it's this pref, and it's all these fancy, shiny objects of like, oh, it's going to do this, and it's going to do that, and it's going to do that. And it's just like, I just want the real stuff. Like, what if it doesn't? What if it all goes bad? What can I expect? And that's kind of why I was writing some numbers down. Rent roll 5.02, appreciation 5-year 92% on the cycle. And I was just putting down some of the returns, and it's like, I know 92% sounds huge, but that's over a 5-year span. And when you're looking at it, I want you to really kind of look at this as this is a cash flow first, appreciation second model. But it's one that's got a really strong probability because of where they're buying, what they're buying, how they're doing it, that you're probably going to have a good, a good run with it. And that's what we're looking at. We're always looking to diversify. I know a lot of you work with the Fullers and a lot of the other PMC members. And if that's working for you, awesome. But some of you have been asking us, literally asking us, what else? I get calls all the time. I just on a call 2 days ago, and they were just like, well, what else are you looking at? What other things, are you seeing that you like? Well, I like this one, especially if there's a tax, play in it, and you're just looking for like that diversifier in your portfolio that's just smooth and steady, and it's just like, that's exactly what this is. And it was kind of cool to see the two CPAs chiming in on that, and obviously they love it and they understand the tax component of where this can be beneficial. So, when you're looking at just the returns and you're saying, oh, 5.2, I can do way better just lending on private money club. Indeed, but you're not going to get that tax part. You're not going to get that depreciation part. And remember, LPs are 80%. So that could be sizable. I don't know. I'm not a CPA, but that consult with your CPA or tax professional on that. I just think, when we're going down this journey, Stephen and I, we're always looking for unique opportunities for all of you. And I think this is a really, really unique opportunity, one different than any of the other ones we've brought you up to date. And I think, Dan, yes, I guess I'm kind of more tied to the backstory and the snowboarding, but, just knowing that whole life cycle, that this isn't somebody that's been in real estate, like, just running the gamut, been with this company and that company. Like, he was an investor first. He was an investor first, looking for a tax deduction because he was getting crushed in taxes as a professional snowboarder. And he just found himself here because of his own personal journey. He didn't just get into real estate because he was looking to make a bunch of money syndicating and going out and seeking investors. He did it because he himself was the investor. And I think that's what we're always looking for. Whether it's IBC, you should never take advice from anybody about the infinite banking concept that isn't using the infinite banking concept themselves. I think that's just ludicrous to think about it. You should never invest with somebody that isn't investing in what you're investing in. Like when I talk about advisors, like clients never ask their advisor, are you investing in this exact same thing you're recommending? They're slinging around variable annuities. The first question you should ask, is your money in this? Show me, prove it. Like, that's the thing, folks. Like, you just got to just follow the dollar and you'll usually find the truth, or follow the story and you'll find the truth. And I think that's what was so unique about this. I'm going to put that link up one more time, folks. So if any of you want to, book a call with Mike and Dan, about the opportunity that, he was just showing and the other opportunities that they have, there's the link. I think this could be really good for some of you based on, things that we know. And I saw the names, so I know who you are. And actually, you know what I didn't ask? Folks, out of all of you left on here, how many of you are here for the first time? Is there any first timers? Just put first in the chat. Every week we have a bunch of new people, and I'm remiss that I didn't ask earlier. Did you guys find value in this? Like, did you learn something? Was this valuable? Was this I mean, listen, if you're all here still, that means you've spent the last hour and 27 minutes with us. Love it. That's how we gauge our success, Dan. We gauge our success by the value that our clan, our campfire, as we call it, gets out of it. So Dan, thank you so much for joining. And I got one special thing I wanted to play. It's 4 minutes. I kind of
I got one question before you play it, Chris. One question. Dan, when are we going snowboarding, man?
Yes, best question ever.
You tell me. I mean, hey, I'm at Mount Hood, so you guys want to come on out? Let's do some laps. I would absolutely love to ride.
What resort are you riding now?
Mount Hood. I'm just north of Portland, Oregon, so Washington State. My wife has family out here, and so that's where I'm hunkered down there. But yeah, Minnesota is every now and then, but I'm really Mount Hood is my go-to resort. And if I want to get really serious, I'll maybe fly to Utah for just a weekend or something.
You got any connections over there with the camps in Mount Hood? Like, can you get people in the camps?
Yeah, well, I can't necessarily get kids in the camps, but as far as
like, for example, let's just say me and Steven wanted to take a road trip out to Portland in the summer, and we wanted to go ride Mount Hood. Could we get in the park?
I'm pretty dang sure we could find a way to get in the park. Yeah.
All right. Yeah. That would be sick, Steven. I think that's the way. Because hey, listen, you can say I snowboard, you can say I've done this, but can you say you were snowboarding in July? That's the question you should be asking yourself, because that's what Mount Hood is. It's a glacier and you can ride all summer long. It's pretty epic riding when it's 70, 80 degrees out.
Yep, that's good. It is unique. I worked there for a whole summer. It was great. Right before I started getting paid, I was up there all summer. It was awesome.
Oh man, I got on Van's team, and they had me out there as a coach the one summer. Listen, like I got myself into a lot of, not trouble, but just got myself in a lot of predicaments out there, and it was insane. Those jumps, I remember there was one that nobody was hitting, and they're just like, well, I think you got to just start from here. So I just beelined it. Again, I should be just called the overjumper. I just shot all the way past the landing. And that was like, that was day number one. It's always
that's nightmare territory, Chris. I mean, I've had nightmares where I woke up because I overshot a jump while I was sleeping, and I woke up terrified. So yeah, to actually do it, I can only imagine how that was looking down.
Well, I caught the tail end of it. I didn't get hurt, but I was also a young buck, so my body was rubber. And nowadays, that would probably have been a broken back.
Yep.
All right. Well, with that being said, folks, what I'm going to do is I'm going to play a final video. You guys should enjoy this. And if you're not going to stick around for it, we really thank you for all your time you spent with us today. And looking forward to seeing you many more. Again, book calls with Dan and Mike. And with that being said, enjoy this clip. I'm going to call that a soft landing, and that is exactly what the Fed will not be able to do. So with that being said, folks, thank you all for joining us for another episode of Wealth Webinar. And Dan, thank you so much for your time and allowing me to have some fun with the snowboard vids.
Thanks for having me. A pleasure being here, you guys.
All right, so I hope you guys enjoyed that episode. We're putting up tons of them, but I think if you like this one, you'll probably like that video as well. Not only that, I've got a book that I created, Mapping Out the Millionaire Mystery, where we actually show you what the wealthy do in the game they play with money. I want you to have that for free. And if you want to know about all my new videos coming up, click that alert button. Actually, smash that alert button, and you'll be notified every time we put a new video. So we'll see you on the next episode.